Dr. Felicia Levy, and this is the cost of capital. Since unique risk can be eliminated by holding a diversified portfolio, systematic risk is the only risk that investors require compensation for taking on. We concluded in our risk and return discussion that we could rely on the CAPM to arrive at the expected rate of return for a particular investment. Now we can address the practical concerns that make implementing this concept very difficult. Our discussions of investment analysis up to this point have focused on evaluating individual projects. Our assumption is that the rate used to discount the cash flows for a project reflects the risks associated with the incremental after-tax cash flows from that project. We know that unsystematic risk can be eliminated by creating a diversified portfolio, and that systematic risk is the only risk investors require compensation for taking on. Conceptually, this makes sense. But how is it implemented in practice? Firms do not issue publicly traded shares for individual projects. This means that analysts do not have the stock returns necessary to use a regression analysis to estimate beta like we did when we were looking at risk and return. They have no way to directly estimate the discount rate that reflects the systematic risk of the incremental cash flows from a particular project. Because we can't estimate risk for an individual project, we end up estimating the cost of capital for the firm as a whole, and then requiring everyone within the firm to use this cost of capital to discount the cash flows for all projects. The problem with this approach is that projects don't all have the same level of risk. A firm's overall cost of capital is actually a weighted average of the cost of capital for these projects, where the weights reflect the relative values of the projects. Remember on the accounting balance sheet, assets were on the left and liabilities and equity were on the right? That is a reflection of historical cost. We can apply the same concept to create the finance balance sheet, but instead of using historical values, we need to use market values. The market value of a firm's assets, or the present value of the cash flows those assets are expected to generate in the future, must equal the market value of the claims on those cash flows, the firm's liabilities and equity. Now, if analysts at a firm could estimate the betas for each of the firm's individual projects, they could estimate the beta for the entire firm as a weighted average of the betas for the individual projects. But since that's unrealistic, they can't use the standard beta approach. What they can do, however, is use their knowledge of the finance balance sheet, along with the concept of market efficiency, to estimate the cost of capital for the firm. Rather than performing calculations for the individual projects represented on the left-hand side of the finance balance sheet, analysts perform a similar set of calculations for the different types of financing, both debt and equity, on the right-hand side of the finance balance sheet. As long as they can estimate the cost of each type of financing by observing that cost in the capital markets, they can compute the weighted average cost of capital for the firm. Let's walk through an example. Here we see that the total value of the firm is $4 million. We know that $300,000 is debt. Since debt plus equity equals the total market value, we can find the equity value by subtracting $300,000 from $4 million. When we do this, we find that the equity is equal to $3,700,000. Now what we need to do is convert the dollar values to percentage values. Remember, the total percentage must equal 100%. Finally, we can use the weighted average cost of capital formula, and we can see that the firm's weighted average cost of capital is equal to 9.7%. Now that we know how to find the weighted average cost of capital, let's take a look at the debt component. We have no way of knowing the rate of return that investors require for a particular type of financing. The best we can do is estimate. There is a cost associated with each type of debt that a firm uses, but when we estimate the cost of debt, we focus on long-term debt. Remember, long-term debt is debt that matures in more than 1 year. Debt with maturity of more than 1 year can typically be viewed as permanent debt because firms often borrow the money to pay off this debt when it matures. When we calculate the cost of debt, it is as of a point in time. Interest rates change over time, and when they do, the cost of debt changes. In the U.S., firms can deduct interest payments for tax purposes. In other words, every dollar a firm pays in interest reduces the firm's taxable income by $1. So if the firm's marginal tax rate is 35%, the firm's total tax bill will be reduced by 35 cents for every dollar of interest it pays. $1 of interest would actually cost this firm only 65 cents because the firm would save 35 cents on its taxes. In the example on this slide, we know that the marginal cost of debt is 20% and the cost of debt is 6%. So we can find the after-tax cost of debt, which is equal to 4.8%. We know that every time debt is issued, there's an associated interest rate. Since interest rates continually change, it stands to reason that each debt issuance will have a unique interest rate. The same can be said of equity. Stock prices continually fluctuate. So for both debt and equity, we must first estimate the cost of the individual debt issued or the individual equity price, and then calculate a weighted average of these costs. Just as information about market rates of return is used to estimate the cost of debt, market information is also used to estimate the cost of equity. This is the same formula that we learned about in our risk and return discussion. To apply it to equity, we say that the expected return is the cost of the common stock. Now, it is not possible to directly observe the market risk premium. We don't know what rate of return investors expect for the market portfolio at a particular point in time. So we cannot simply calculate the market risk premium as a difference between the expected rate on the market and the risk-free rate. What we can do is use a measure of the average risk premium investors have actually earned in the past as an indication of the risk premium they might require today.